Receiving dividend income is nice, but not paying federal taxes on these dividends is even nicer. Basically, paying federal taxes on dividends eats away at the benefit of receiving a dividend in the first place. Of course, it's a bit difficult to avoid paying federal income taxes, and I'm not giving you any type of tax or legal advice, but we will look at 3 ways that you can avoid paying federal taxes on dividends. Number 3 on our list might be the most doable for you, but please check with your tax advisor before you do anything. As you may already know, if you own stock in a company, dividends are just your share of the company's profits. Dividends provide income while still allowing you to profit from the appreciation of the stock. When it comes to taxes, all dividends aren't the same though. The thing is, your federal taxes are affected by whether a dividend is qualified or non-qualified. Sometimes you will hear people call non-qualified dividends ordinary dividends because just like your salary, non-qualified dividends are taxed at your ordinary federal income tax rate. This means the higher your taxable income, the more you will pay in taxes on your non-qualified dividends. Qualified dividends are better because you use capital gains rates for these dividends. Capital gains tax rates are lower than your ordinary tax rate. For instance, if you're married filing jointly and in the 35% tax bracket, your ordinary dividends will be taxed at 35%, but your qualified dividends will be taxed at either 15% or 20%. As a matter of fact, the highest tax that you will ever pay on qualified dividends is 20%. Since you can't avoid paying taxes on non-qualified dividends, the first thing you want to do is try to make sure that your dividends are qualified. Your financial institution will classify and report your dividends as qualified or ordinary, but it's still good to know the requirements so you can do some tax planning. With that being said, the requirements are slightly different for preferred stocks, but a dividend received from a common stock has to have 3 things for it to be qualified. A, it has to be paid by a U.S. corporation or a foreign company that trades on a major U.S. exchange. There are also a couple of other circumstances when a foreign corporation would qualify. Please take a look at your screen for those circumstances. B, you have to hold the investment unhedged for more than 60 days during the 121-day period before the ex-dividend date. Normally, the ex-dividend date is 1 market day before the dividend's date of record. Your holding period does not include the day that you purchased the investment, but it does include the day that you sold it. The bottom line here is to make sure that you don't sell your dividend-paying stocks within that 60-day holding period. C, the IRS has to say that it's a dividend. Some dividends don't qualify even if it's called a dividend. Some examples would be dividends from co-ops or tax-exempt organizations, annual distributions from credit unions, employee stock options, special one-time dividends, or premium refunds from an insurance company, just to name a few. Although there are some exceptions to these 3 requirements, if you don't meet them, you would have to treat your dividend as ordinary income on your federal taxes for that year. So try to meet these 3 requirements so you can at least get a tax break. So a couple of more things before we get into 3 ways that you can avoid paying federal taxes on dividends. Please remember, even if you reinvest your dividends, you will still have to pay taxes on the dividends that were reinvested. When it comes to stock dividends, you won't have to pay federal taxes until you sell the stock. So we know that you cannot avoid paying taxes on non-qualified dividends, but you do have a chance to avoid federal income taxes on qualified dividends. Here are 3 ways. 1, own dividend-paying stock in a 529 plan. If you want to contribute to the education of a family member or friend, a 529 plan is good for tax-free growth and withdrawals. As long as the withdrawals are for qualified education expenses, then dividends received within the account would be tax-free. 2, own your dividend-paying stock in a Roth retirement account. I know that a lot of retirees will invest in stocks that pay dividends so they can use the dividends for living expenses while still holding on to the stock. If you're in this situation, you should consider owning your dividend-paying stocks inside your Roth account. If you haven't retired yet and you don't need the dividend income right now, then owning dividend-paying stocks within a Roth might work for you too. Since a Roth account is funded with after-tax money and all growth within the account can be withdrawn tax-free, dividends received inside the account will be tax-free as well. The catch here, though, is in order for the dividends to be tax-free, you can't withdraw the dividends until after age 59 and a half, and the account has to be open for at least 5 years when you take your withdrawals. This won't work with other retirement accounts because when you finally withdraw your dividends during retirement, the dividends would be taxable. 3, reduce your income to the point where you owe no capital gains taxes. Here, your overall goal is to lower your taxable income to the 22% federal tax bracket. If you're in the 22% bracket or lower, you don't have to pay capital gains taxes at all. So for example, if you're married filing jointly and you can manage to get your taxable income down to $94,050, you won't owe any taxes on your qualified dividends. Not only that, reducing your taxable income might help you avoid the additional 3.8% net investment income tax as well. I plan to make a video about the net investment income tax, so if you are interested, you might want to come back later and check out that video. Really good tax planning can help you lower your income to the lowest income tax bracket. What I mean by planning is determining ahead of time how much you should put into retirement accounts, into a health spending account, or if you would benefit from starting a side business and so on. Basically, anything that would help reduce your income for tax purposes. If you aren't able to use any of the 3 methods mentioned to get around paying taxes on your dividends, you should consider tax loss harvesting. Tax loss harvesting is when you sell a losing stock so that you can offset the gains from selling a winning stock. Any losses can also be used to offset dividends. This strategy is especially useful if you're holding stock at a loss and think that it may not recover. If you want to know more about tax loss harvesting, please watch the video on the lower right of your screen. All the best.